Hi guys, Assalamu alaikum. This is Mubassir and you're watching TBM. Today's tabsra is about the forex markets, and for this week I will be covering on this episode. I will take you through the fundamentals that have moved the forex markets, and I will also take you through the technicals, and we will see how the week has played out. What's important to consider here is that this week there were two primary news event drivers that moved on the fundamental level. There was the CPI, which is the consumer price inflation, and then the PPI, the producer price index. Both these two are key inflation numbers and which then directly correlate to whether the Fed will be increasing interest rates, and they then have a direct impact not just on the forex markets but your stock markets, your commodity markets, and everyone is influenced by these economic indicators. For this particular video we will be covering specifically the forex market, so I will be taking you through the euro dollar in particular, but within the fundamental capacity I will also cover what's happening, some important updates around the Japanese yen, around the euro dollar and the dollar index as well. Stay tuned. If these are asset classes that you are interested in, then you do not want to miss this one, because we will talk about some important parameters that have influenced these markets. And stay tuned, watch till the very end, and I will see you after the intro and disclaimer. Alright, so coming forward now, first let's talk about the fundamentals. Some of the important fundamental, I briefly talked about the consumer price index. So this week there were two, as I mentioned in the earlier intro part of the video, there were two primarily movers, the consumer price index and the producer price index. So for this week, I will take you through, let's have a look. This is Forex Factory, and we can see that this week, the week that just concluded, inflation number came in hot at 3.2% versus the expected 3.1. Now, what this indicates is that inflation is higher than it was expected. When inflation is higher, mind you that the US Fed keeps us target, a target inflation number of 2%. This 3.1 is higher than that, and as long as they do not achieve that 2% desired inflation number year over year, they will keep on raising the interest rates. Right now the interest rates are around 5%, and as long as they do not get that conviction that interest rates are that inflation is coming down towards 2%, they will not be increasing, lowering the interest rates. Now mind you, there's also an important factor to consider here. For at the start of the year, there's this tool, the CME tool watch. They put forward an expectation that at the start of the year they were eyeing at a 70% probability that the Fed will be lowering interest rates. Now we're already in March. The expectation or the probability was for 70%. Now it is unlikely. The Fed will meet next week. They are expected to release their announcement on the interest rates, and it is largely expected to remain unchanged. And why? Because the inflation is not near the 2% number, and at the same time the last jobs report reflected an addition of around 275,000 jobs within the US economy. So that is an indication that the economy is resilient. When the economy is showing resilience, inflation is also higher, then the Fed has no real incentive. Had there been a recessionary condition or market, then they would have that added pressure that we need to rush towards lowering down interest rates. But because that is not the case, the economy is showing resilience, and the inflation is also not at the desired number. Now the CME tool watch says that the expectation is around 60% for the first rate cut to come in around June. And we will then keep on this for this week. Next week they're meeting up, and the largely consensus is that the rate will remain unchanged. Now what this does is, when the inflation number is high, interest rates are expected to remain high, the US dollar goes up, the dollar index goes up, and as the dollar index goes up, the euro dollar comes down, because it is a dollar denominated currency pair. With your dollar going up, euro coming down, and we will then see also see that reflected within the charts as well, that the euro has been coming down. And later in the later portion of this video, when I'll take you through the chart, you will see that how the euro fell from its opening price for the week, and overall for the week it ended lower than where it opened for the week. Mind you, the second important factor that I also talked about, before moving on, for the consumer price index, year over year, both for Jan and Feb. For January, it was also higher. The expected number was at 3.2%, but it then came in at 3.4%. And for Feb as well, the forecast was for a 2.9%, but it came out at 3.1. So inflation is still hot, inflation is still high. And there are, Jerome Powell, the Fed chair, has been saying that we need more confirmation. Similar statements are also being coming from the European Central Bank. Christine Lagarde, the chair, has said we need more data points, more conviction to actually be more confident that the time is right to start lowering interest rates. Mind you, in Europe, conditions or the German economy has been showing signs of weakness. Inflation is on a rise. The recent numbers that came in from the French economy, inflation also going up, and the European economy is not looking as strong as one would expect it to be. And so there is an expectation that the interest rates need to be brought down so in order to boost the economy to grow further. The second important, I talked about the PPI. Now mind you, the PPI is the producer price index. What happened this time around is the expectation was for around 0.1%, but the number came in at around 0.3%. The expectation for the PPI, this was for the month over month. What we need to look at is the PPI, core PPI. Yep. The forecast was for a 0.3%, but it came in double at 0.6%. Now, why is that worrying? Mind you, for the US Fed, the producer price index is actually a more preferred indicator as opposed to the consumer price index because it is considered a leading indicator. If the producers are passing on higher prices to the retailers, they then will pass on higher prices to the consumers. So while the consumer price index at the consumer end is reflecting higher prices, if the PPI is higher, that is a leading indicator that for the following month, prices passed on to the consumers will also be higher. So the US Fed pays more attention or more scrutiny, you could say, to the PPI numbers, and that came in double. Against a forecast of 0.3%, it came in at 0.6%. And when we will see in the charts as well, you would see a massive, for the week, the largest drop of the week came in on the day when the PPI number was released. Why? Again, because if the PPI comes in double, that means the odds of interest rates coming down go lower, and the fact that the US dollar then shows additional strength. Because the odds that further pushes, mind you, then the 70% odds that were being eyed for June then went down to 60%, and that then reflects in strength for the dollar and weakness for the euro, which then reflected in a larger drop in the euro dollar. Moving forward, for some additional points on the fundamental aspect, we already talked about this 60% rate. We have already talked about it. At the ECB, as I mentioned earlier, rates are already currently at 4%, and they're eyeing for more information and waiting. In my opinion, they'll move in tandem with what the US Fed does. So the Fed is expected to reduce interest rates within June, and the European Central Bank will follow suit. Bank of England will follow suit. What's interesting here, a different twist to the mix, is what's happening in Japan. In Japan, CNBC also, an analyst at CNBC also talked about that in Japan, the Bank of Japan is likely to raise interest rates for the first time in around 17 years. They've had a very different policy from the rest of the world where they've deployed negative interest rates, but they've also stuck with the higher inflation numbers. And recently, an analyst on CNBC was talking about how they recently negotiated a significant, Toyota and Honda negotiated a significantly higher growth in wages with a labor union. And with higher wage numbers, higher inflation numbers, the odds are more inclined towards the Bank of Japan increasing their interest rates after a very long time of a yield curve control policy, as it is called. So that would be interesting. They are expected to Bank of Japan has their meeting within the next week. The expectation is whether they might raise interest rates within this meeting or in the follow-up which they have towards the later half of April. So we'll have to keep an eye out on what happens on this front. So now let's move on to the technical part. Let's look at the graph, the charts, what they tell us. But now we already have established some information on the fundamental bit, that inflation was high, PPI was high. And for the next week upcoming, we're not expecting interest rates. We're expecting them to remain changed. No signs of them going lower. This indicates strength in the dollar and weakness in the euro dollar. So with that in mind, let's also see how that reflects in the charts. On the weekly chart, as I mentioned earlier in my commentary, we saw price here coming down from a high, a state of premium, breaks this low. This is a bearish structure, a shift in structure. And with that bearish shift in structure, I see price going up and finding resistance. When sentiment is bearish, I expect up close candles to act as resistance levels. We see that for the week prior to the one just closed, this one, we saw it stopping below the midpoint, and this does not prove that it is a resistance level. It gives an indication that this might be a resistance level. We then wait for confirmations, and we can then see at the same time on the daily how the daily has played out for this week. For further information, whenever we do not see further information, for example, we've established that I believe this level will act as potential resistance, I will then go down on smaller time frames for further confirmations. So while I'll keep the daily here, I'll move this weekly to the 4-hour time frame. Now every candle represents a 4-hour candle, and what we see here, this is Friday and now Sunday. Now this is where we're beginning this week. Now if I see bearishness at this point, the week starts. This is the first 4-hour candle for the week, and when I see if I see resistance around at this point, I will then want to take it through, because my trading strategy involves around following price as it breaks support levels, turning to resistance, or breaking resistance, turning to support. But every time I'm looking at this phenomena, I have an eye of where I believe price will go to, and for me, price is always going towards liquidity pools which lie above highs, below lows, and also towards inefficiencies within the marketplace. So price will only go towards the highs and lows, important highs and lows, or towards inefficiencies which are reflected in form of these gaps. So if I see resistance at this point, I will take down this drop here and I go here, targeting this low. Now this breaking of this low is a market structure shift towards the downside, bearish structure, bearish sentiment, and if the sentiment is bearish, as I already mentioned on the weekly time frame, I will expect this up close candle to act as resistance, which it does exactly that, acting as resistance here, and then my target would be this low, and I will take down that low. Mind you, my actual entries are on the 1-minute time frame, so I'm following these higher time frames are helping me give me a directional bias, and once I have that bias in place, I'm following movements of price on the smaller time frame step by step, as I just showed you, from weekly, daily, 4-hour, 1 hour, 15 minutes, 5, and then 1, to then actually take my entries on the 1-minute time frame. Here I am presenting you that overview of how that same thought process applies on a higher time frame, and then the same I deploy on the smaller time frames. Here I see price finding support here. See how this level price rushed below it, back up. I would then expect this level to act as support. This is what it does, pushing price up. Let me pull up the 1-hour time frame here, just for reference, and again we go down on the smaller time frames to give us more clarity, more information. I told you we're expecting resistance at this point. See how price touches this level on the 1-hour breakout structure. This sudden spike up, this was CPI. I do not trade CPI, I do not trade FOMC. These news events are very volatile and they cause a lot of erratic movement. You tend to get stopped out. So it's wise to first wait, let that initial craziness of an important high impact news event come into the marketplace, and then I proceed further with whatever the market presents to me. And then if we go further beyond, we saw this price showing us bullish, finding support here, going up. We see this here. Price is then finding support at this gap inside of this, while it is trying to come down, but it is not breaking this gap, staying within it. And then on the smaller time frame, as soon as I find my confirmation to go bullish, I'm targeting this high, which on the 4-hour is an important swing high here. And once it breaks this, I find this level that it just left, this gap that is just left, which was acting as potential resistance, broken, resistance broken, now acts as support, and I will then look for a buy setup on this level and then target this high, the base of this high. I do not need it to go to the very extreme. When you're scalping on the 1 minute time frame, you're good with 10, 15, 20 pips, whatever the market present itself. And we can even do a quick check of how big a move this will be. If we can catch from somewhere here and then take it to here, this is 24 pips, more than enough for any scalper, day trader. That is my style. You could say it is day trading more inclined towards scalping. Those who are more towards swing trading, they will then be taking their setups on the 1 hour time frame. They would not be going any further down. And then we could see this week also then coming down. This then happened on the PPI day, the massive drop. It is even more obvious on the daily time frame. Let me just quickly go back and show you this. See, when to all those who claim that it is the technicals which move the markets, let me present my humble correction. It is the fundamentals which drive the markets. The technicals are the footprints of how price action or an asset class is presenting itself. And I myself am a technical trader, but I respect and I understand the fact that it is the fundamentals which are moving sentiment and driving the prices of assets. See, this was Thursday, and on Thursday we saw let's have a quick check. PBI came in at Thursday and this was the same 0.3, 0.6 double. And that then reflected in a strength for the dollar and a massive weakness for the euro dollar. Now for the week ahead, let me just zoom back out on the weekly and we will then quickly just wrap this up. Bearish structure, found resistance at this level, breakup structure on the daily, swing low broken, breakup structure. Now mind you, next week we have FOMC, and with the narrative I shared with you on the fundamental level that the Fed will not be changing, lowering interest rates. So I expect the dollar to go strong, go up within the coming week, and as the dollar will go up, I expect the euro to go down. And with this break of structure, I expect the euro to come around. It can sweep this low. This is what the direction that I will be eyeing. And mind you, as I mentioned, because I am taking trades on the 1 minute time frame, for me, I will be monitoring what price action gives me if there are retracements within the week. The challenge with the 1 minute time frame is you cannot just take a trade off of the weekly or the daily level time frame. You might still end up on the week at this level, but within the week, maybe mid of the week, we might see big retracements back up, which might appear as bullish moves on the 1 minute time frame, obvious bullish moves, maybe even on the 15 minute or the 1 hour time frame. So we have to keep all these things in mind, and I personally like to break down from, as many people call it, a multi-time frame analysis. You move down from those time frames and you have to be very selective about your setups. You cannot just react on every move that the market presents itself, because it will then stop you out every time. And in these markets, as I've mentioned before as well, your number one priority is protecting your capital, being smart. You can only lose when you enter a trade, you do not lose anything when you're on the sidelines. So guys, that's about it. I hope you found this video useful. If you find value in this and want to see similar content, make sure to share this within your network, like the video, and that will be your feedback to me that you want to continue seeing similar content like this. Stay tuned with the channel, and I will see you on the next one.